I'm just going to be honest with you guys. Before Powell, I thought there was a really good chance that we would get a 5% give or take downside move in the Russell by this Friday. Now, yes, if you consider the top of the FOMC rally itself, when Powell was actually speaking, you have now fallen about 5.5%. But just today alone, you're down 3.6%. Okay, here's honesty for you. We could be screwed. I'm not even gonna lie to you. We've had earnings that has come in pretty good, relatively okay, for especially Meta yesterday and after hours. Lots of AI hype was going on over at Meta. You basically all of your big tech has done okay. Now, I think that's not why the markets are freaking out today. Panicking, if you will. I think it has nothing to do with earnings itself. I really don't think it has anything to do with the Fed either. And yes, these things are affecting the markets, but the core of this, I don't think, is caused by Powell or earnings. I think the core of this sell-off that we've been seeing, and especially today, is in regards to recession fears. And it almost looks like, now I don't want to get too tinfoil hat on you guys, but it almost looks like the data tomorrow was leaked. Yes. Judging off of what we're seeing in markets, the Russell taking it on the chin, way harder than the NASDAQ or the S&P today. Now, if we're going into recession, you would expect that from the Russell. Or if just recession fears start to grow, you would expect the Russell to see a large sell-off. Now, the Russell has outperformed in recent days, and I do think part of this extreme sell-off in the Russell today was due to the Fed. Yes, we had good news from the Fed, but I mean, it was already priced in, right? So it's kind of a sell the news event in the Russell. But I think a lot of this pricing in as well is recession fears. Why do I think that? Well, consider what happened to TLT. TLT yesterday was up 1%. Great. Okay. The Fed was dovish. Expectations for rate increases rose upon what the Fed said. But take a look today. Again, as stocks are selling off, TLT is going higher. Now, TLT is the ETF that tracks the 20-year Treasury. So when TLT goes higher, that means yields are falling. And 10-year Treasury yields fell a lot today. 10-year Treasury yields fell about 12 basis points today. You're down to 3.98%. Now, why is long duration Treasuries falling? Because let's be honest, 10-year Treasuries have already priced in Fed policy. You're likely not going to get a lockstep move with 10-year Treasuries relative to what the Fed is doing with the federal funds rate. Okay, so what I mean by that is if the Fed comes out September and they cut rates 25 basis points, your 10-year Treasury yield's not going to drop 25 basis points. It's going to affect the short end most. But yet again today, you've fallen 12 basis points. So what you're really seeing going on is a flight to safety. You're seeing investors that want to lock in these yields, that want to potentially gain some capital appreciation if markets do start to fall, if the economy does get worse. Now, again, just judging off of what we've seen today, big tech got destroyed, the Russell got destroyed, the S&P got destroyed, everything got destroyed. Big money, they know things before we do, right? And coincidentally, today, when you're seeing all of this carnage, you have big economic data tomorrow, like massive Massive economic data. The Fed was really a sideshow compared to the data that we get tomorrow. Typically, the Fed is the most important thing, but I will explain why tomorrow is really the main event for this week and potentially the next couple of weeks. And if you guys did not watch the last video at all, it is non-farm payrolls. You come out tomorrow, 8:30 in the morning, you're expecting 175,000 job ads. Now, this number I don't think matters, okay? I don't think the non-farm payrolls matters too much unless we get a big fall or a big increase, right? Above or below expectations. For an example, if we get 120,000 jobs, yeah, that's going to cause some fear in markets. Under 100,000 jobs, likely panic, okay? Is that an expectation that is most likely? No, right? Most likely we're probably going to come in plus or minus 20,000. So maybe as low as 155, maybe as high as 205, right? Or 195, maybe over 200,000, who knows? I actually think if non-farm payrolls come in high, then you're probably going to get a lot of enthusiasm by Wall Street. Wall Street's going to say, that's great. Recession, it's not here. It's not coming. The unemployment rate is the most important part of tomorrow because you're sitting at 4.1%. The unemployment rate tends to rapidly rise heading into recessions. So over the past 4 unemployment reports, we have gotten a 1/10 tick up over the last 4. Now, if we get a 1/10 tick up in the unemployment rate, that's not good. That's going to cause some fear because you're going to trigger the SOM rule. And at that point, I mean, it's hard to stop unemployment when it starts to rise like this. But if you get over a 1 tick point higher tomorrow, you're looking at mass panic, okay? Like panic selling, something we have not had in a very long time, will be coming to markets. If the unemployment rate jumps to 4.3%, we're screwed, okay? That's still a very low number, but it's the momentum, it's the trajectory of this that will start to spook investors big time. Now, I want you guys to take note of what happened in 2022, okay? This is the best kind of explanation I can give to you guys. 2022, what happened? Recession risks were rising. At one point, when the markets were down, from peak to trough in October, about 26.5%, you were pricing in a 100% chance of a recession. Well, markets have done exceptionally well because there has been no recession. And a lot of people just chalked it up to a rolling recession, that different areas of the economy were getting hit at different times. And that was not enough to cause, a wider recession. You've since seen data start to come out bad, especially anecdotal data, which is something Fed Jerome Powell talked about yesterday, starting to come out showing the consumers really pulling back. And the consumer spending money is over 70% of the economy. So just from that metric, I mean, that doesn't look great. You could almost say we're screwed from there. But if recession risks start to get priced into markets, which I think you're getting some of that today, but it will be either confirmed or rejected tomorrow. If tomorrow's unemployment report shows a 1/10 tick up in unemployment or more, the worse it's going to be. Like if we get a 3/10 tick up in unemployment, I'm expecting the S&P is going to drop at least 3% tomorrow. At least, bare minimum. Could be more than that. Then you're going to rapidly start to price in recession risk into our markets. Just to kind of put this into a little bit of perspective for you, if we were to fall another 26%, that would put the S&P back to 400. That would be a $142 drop from here in the S&P. Now, just to get back to where we started, really 2024 at, or the lows of 2023, that would be a 25.5% decline from here and put you back to about 405. Now, I think this would almost guarantee a 15% or so correction if we do get bad data coming out tomorrow, which could put the selling to be done around 480 or so on the S&P. That is $62 of downside for the SPY from here. And I mean, honestly, it could get way worse than that if we do start to actually price in a recession, because nobody's been prepared for that. Some people have thought, hey, recession's possible, there's a risk of recession, but nobody's actually had to come to terms of actually pricing that in. So just pricing that in, recession risk, let's say 20%, 25%. That's going to mean some pretty severe downside for markets, let alone if you jump to 50% odds of a recession. Even a coin toss, which I think is better priced with reality. I think there's probably a 50-60% chance of a recession over the next 12 months. That makes sense. Right now, markets are saying there's a 0% chance of a recession. And that's why tomorrow is so important. And again, it almost looks like the data was leaked today. Not to retail, of course. God forbid you leak retail some data that could help them. But to big money, to the algorithms. They're definitely trading today, or did trade today, based on maybe some information that they shouldn't have, I guess. And I know I'm putting a tinfoil hat on this, but based on what we got today, tomorrow could be a very rough day for markets. Now, Tesla was also down north, or south, I should say, of 5%. It's a rough day. Now, if the data was not leaked and if the unemployment rate comes out okay tomorrow, then I do think Tesla and the rest of the markets, especially interest rate sensitive, economic sensitive, like small caps, will do better, right? Because earnings have been okay. The Fed was more dovish than we expected. Yesterday after the Fed, I was really reconsidering some of my bearish theses, right? Because yes, we got everything we expected. And even more than that, like Powell was very, very dovish yesterday. And it had me rethinking some of my bearish theses. But after today, I don't even think Powell matters anymore. I think the markets are over Powell. I think the markets really don't care about rate cuts anymore. In terms of the actual cut itself, the markets are more focused on the reason for rate cuts, what the economy is doing, even earnings. The markets kind of shrugged off good earnings from companies that reported good earnings. So I think the only thing that markets really care about right now is recession, potential recession or no recession. Now, there's Iran retaliation that is supposedly coming soon. That obviously could be having an effect on markets. The sell the news event from the Fed. Some earnings have been on the poor side, like Microsoft. But I don't think that even matters to the markets anymore. I think it's all about the economy. It's all about the economic data. And if today was any insight to what tomorrow's data could look like, we could be screwed for a period in time. Now, there is also going to be election uncertainty and likely selling that will come in as well, some point in the month of August or September. that is also something that can transpire. But I don't even think that matters in the grand scope of things. Not compared to the economy. I mean, the sheer amount of selling today is just incredible. Maybe because it's been so long since we have had, a couple of days of excessive downside. And I think markets, they're just not even prepared for it. I don't think a lot of big money is bearish by any means. Big money is bullish as hell. From that perspective, there could be a lot more downside from here. If you look at the net positioning in markets, it's extremely bullish as well. Some of the lowest levels of cash that you have seen in a long time, that doesn't look very prudent to what you probably should be doing if you're managing people's money, especially as the markets are really now starting to sell off. As recession risks have been growing, as the data has gotten worse, it looks like there could be more selling, there could be more hedging. And again, if you want my honest opinion, I think the data was leaked tomorrow. I think this selling today really just, I guess, snitches, if you will, to what to expect tomorrow. The unemployment rate is probably going higher, judging off of the selling that we are seeing today. Now, what does that mean for Tesla? Well, obviously, Tesla is an economically sensitive company. It's a cyclical company, whether we want to agree with that or not, it is. All autos are cyclical in nature. Until Tesla really has robo-taxis up and operational, Tesla will be a cyclical business. Meaning, if the economy does well, Tesla will do well. If the economy does poorly, Tesla will do poorly. And as you start to price in a worse economy, a worsening economy, a recessionary economy potentially coming tomorrow, I don't think that bodes well for Tesla. Now, I think until the markets get over that hump of pricing in a recession, then I think Tesla can do okay. I'm still expecting Tesla will stay above that 50-day moving average at $208 per share. And again, Tesla was down big time today. The markets were down big time today. You're better priced for bad data tomorrow, but you're not priced at all for a recession. So if the data is just a little bit bad on the economy, non-farms come in low, unemployment rate stays the same, we're fine. But again, judging off of what we've seen today, I think the data was leaked to some big money investors. Just my opinion. We've had a lot of important data in the past year, and no other time have you seen a sell-off like this before that data. You've seen sell-offs after the data, but not before the data, and not to this extreme degree. So just want you guys to be a little prepared. I think cash is king right now. I think you want to be ready to buy the dip when that happens, but don't be too fast to buy the dip either, because normally recessions and recession, crashes can last anywhere from 6 to 12 months before you actually bottom. And I know I fell victim to this. I know a lot of you guys probably fell victim to this, but I started buying the dip way too soon back in 2022. Way too soon. And then I spent the rest of the year averaging down. I don't want to make that mistake again. Specific companies that do go on massive deals, then you obviously have to jump on those opportunities. But as a market as a whole, I think there can still be a lot of downside from here. And I think tomorrow we will look back and say that was a pivotal moment for markets and this recession pricing. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. If you guys want to come stay up to date with all of the trades that we are making, check out that link down below in the description of this video. You guys have a fantastic rest of your day, and I will see you in the next one.